Okay, we are ready to start our final section for this semester. The last 4 weeks, we are going to be dealing with current liabilities and long-term liabilities. We're going to move in and talk about the time value of money. And then we're going to finish up the semester looking at some owner's equity items, specifically stock and how a corporation will handle transactions when they buy or redeem some of their stock. And then the final week, we will look at the statement of cash flows, which is our final financial statement. We've already done the first three way back in the first part of the semester, the income statement, statement of retained earnings, and the balance sheet. And at the end of the semester here, we'll be ready to do the final one, the statement of cash flows. Just a couple of housekeeping items here before we begin. Remember that for our upcoming class, that is the last day that you can submit your project for review. And I do even allow you to submit it by the end of the day. Doesn't have to be just by class time. But then for the following week, for week 13 then, that is when the project is due. And that is due to me by my email or turned in a hard copy by the beginning of class. Okay, so we talked about where we've been. We did this a couple weeks ago as well, that we're over here in the revenues. We were looking at sales returns, sales discounts, cost of goods sold in week 7 and 8 with FIFO and LIFO. We did some account receivables. We did bank recs in the assets, current assets in week 9. We looked at depreciation and gain in sales of assets in week 10. Now we are ready to go to the next section, the liabilities. And the biggest liability that we're going to focus on is payroll. The only payroll item that we had in the liabilities so far would have been a wages payable. But payroll can go way beyond what we have looked at so far. What we've looked at so far is okay, especially if you are paying an independent contractor. In that case, the payroll we've done works just fine, perfect. But that's not realistic when you actually have employees. When you have employees, your journal entry won't look like what we've been doing so far, where you just have one debit and one credit, showing that your workers earned 1,000 and you paid them 1,000. That's not how it really works, as all of you would know by looking at your paychecks. There are taxes taken out, and so what I want us to be able to do is to be able to memorize, and we're going to focus on one at a time. We're going to look at the employee first. Which taxes are taken out of your check? And there are some parts of it that I think are important enough that I want you to memorize them. So when we're doing payroll, the first thing that I want you to remember, and I'm going to go ahead and put this in, is whenever there's a payroll entry, for each payroll entry, we're going to have 2 journal entries. So for each payroll entry, there will be 2 journal entries. We're going to have one from looking at it from the employee's paycheck and how much taxes were taken out. And then the second journal entry is the employer. You may or may not have even known this. The employer has to pay taxes of their own just to have somebody work there. Not only does the employee have taxes taken out and the employer has to pay those, but the employer has to pay their own taxes that the employee never sees or has deducted from their check. But we're going to look at the employee side first. The first thing that the taxes are taken out are what you can group together as called FICA taxes. And FICA is, the abbreviation is FICA, which stands for Federal Insurance Contribution Act. And the 2 taxes with FICA are Social Security and Medicare. The items that I want you to have memorized is this percentage here doesn't change. And it's important that you should know how much Social Security is taken out of your taxes. And the answer there is 6.2% of your taxable wages. We're not going to get into what's taxable and what's not. That's for a different class actually called payroll. But we're just going to assume that everything that I mention as wages is taxable for this class. So our wages are always taxed at 6.2%. However, they stop being taxed. So once you hit this dollar amount, 127,200, and that is for the year of 2017. Every year it's different. For every once in a while, a year will be the same as the year before if there was very little inflation. And that did happen for 2015 and 2016. The amounts were quite a bit lower than this. They were 118.5. So you can see the number went up quite a bit just from 2016. So if you're in a future year beyond 2017, just use the number that I have provided to you in the notes. It may or may not be the 127.2. Most likely it'll be a little higher than that. So I do want you to have these two items memorized for the class. And then the second item that goes along with FICA is your Medicare tax. And Medicare is taxed at 1.45%. And then note here, there is no cap. So even if you made $1 million, you're still going to be taxed on your next paycheck at 1.45%. Whereas if you made $1 million here, your next paycheck would not be taxed any for Social Security. And we're going to look at an example of that to show you what I mean. Thus, and we'll see this when we talk about the other taxes. But if I was, let's say my earnings as of the end of November, I was in a high wage bracket and I had earned up till now $125,000. If I had earned $125,000, that means only $2,200 is left until I get to this magic cap number. So only if I had earned, let's say my paycheck was for $10,000 that month, only $2,200 of it, because that's all I had left to get to this cap, would be taxed for Social Security, whereas all $10,000 would be taxed for Medicare. Okay, moving on, there's 3 more normal ones, at least for the state of Indiana. And I say that because some states are different. Everybody, no matter what state you live in, has federal withholdings. And that's what I'm going to abbreviate this out just a little bit more. Federal withholdings, and then we call it federal withholdings payable. All of these are going to be payable accounts. That's why we're talking about the liabilities. These are all items that are withheld from the employee's check, and then within a month or so are going to be paid off to the IRS. So with the federal withholdings, you may or may not know, but that all depends. How much is taken out depends on A, how much you make, and B, how many allowances you claim on your W-4 that you fill out when you start working. Allowances are similar to the number of exemptions you claim on your taxes, but not exactly, but they're close. But either way, I'm going to have to give you this amount on any problems that we do. I'll be giving you the federal withholding percentage. Now with the state, I would like you to get used to the Indiana rate. The Indiana rate is 3.3% on all of your taxable wages. And so we will be using that for our in-class examples. And then also within Indiana, you are taxed at the county level. Every county differs slightly. They're usually between 1% and 2%, somewhere in that range. And so I'm going to be giving that to us as well. Just to give you an example, Delaware County is at a lower percentage for the county than Madison County. Madison County is about 1/4% higher than Delaware for whatever reason. So that's the employee side. Those 5 taxes are going to be taken out every time unless told otherwise. The only reason would be unless I don't give us any county information, or if our pay is already over the 127,200, then those could be not included. Now the second journal entry that we're going to need to do is from the employer's viewpoint of how much taxes they have to pay. They have to pay, the first 2 you'll notice are the FICA taxes again. These FICA taxes, they pay the exact same information that the employee has. So if the employee, when they did their 6.2%, if the employee had to pay in $85, the employer puts in another $85. Same with the Medicare. If the employee put in $15, the employer puts in an additional $15. Now, one number you may hear in the business world for FICA is when you add up these two amounts here, the Social Security and the Medicare, that comes out to be 7.65%. That's what's known as your FICA taxes. 7.65% of any taxable wages goes to FICA. Then the employer puts in the same 7.65%. Now, the bad part about this is if you're self-employed. If you're self-employed, then you have to pay both of these, which is kind of unfair, whereas an employee just has to pay the 7.65%. If you're self-employed, you pay that twice. And thus, if you self-employed usually means if you're an independent contractor. So if you get paid, if you earn $1,000 and your employer pays you $1,000, that doesn't mean you've got out of the taxes. That just means you're going to have to pay the taxes later when you do your 1040 at the end of the year. And then you're going to end up owing these guys, plus the employer portion, plus all of the normal items, the other items here that would be taken out of your taxes. So it's not always the best when you're an independent contractor. It's actually worse because you do get taxed more. That is assuming you pay your taxes as you should. All right, so looking again, now back to the employer side, they pay the same taxes, and we're going to do an example of what this journal entry will look like in just a couple minutes. They also have to pay this tax called FUTA tax, and this stands for the Federal Unemployment Tax Act. And then there's the state version, State Unemployment Tax Act. And if you've ever wondered if somebody's been unemployed and they collect unemployment for an amount of time, this is where the money comes from. It has to come from some kind of a fund, and employers have to pay into this fund. Now, we'll come back to the FUTA in just a second, but for the SUTA, how much the employer pays in, well, that depends on the employer. If the employer is a small employer and they rarely lay anybody off, if ever, then they're going to pay in a very, very small percentage, maybe 1% or less, possibly. Whereas if you're a really large employer and you've had to lay lots of people off in the past, therefore you are taking, your employees are taking money out of the fund, then you should be putting money into the fund. And so companies like GM, who had been laying a lot of people off, would have a very high SUTA rate. Theirs could be all the way up near 10% or close to it. Now, there is a cap, just like with Social Security, but the SUTA cap in Indiana is at $9,500. This is where all of the money comes from that you would get paid for unemployment. Now, the difference between the state and the federal unemployment, the federal unemployment, it has a set rate, which is very low, 0.6%, so not even 1%. If you look at that as a decimal, if you would put that in your calculator as a decimal, 0.006, which is really low. And it's also capped at a very low amount as well. So only the first $7,000 that each employee makes will be taxed at that 0.6%. Now, the federal dollars are there simply to build up as a fund to give loans to the state if they ever run out of money. And that did happen for Indiana back around 2000 and I want to say 10 or 11. Indiana did run out of money. They did have to borrow, and then they do have to pay it back, and then the tax rate for the employer goes up. This number here actually goes up if the state ever has to borrow. Employers have to pay a penalty. They have to pay it back. But we're not going to look at that. That's more of a payroll type class example. So then here, so these are the main items that are taken out of your check, but then there are other items that definitely can be as well taken out of your check. If you are at a full-time position, there's a good chance you have medical insurance, and then you have to pay a part of the premiums. That's money taken directly out of your check that you never see. If you have money put away into a retirement account, if you have money put away for other things, that any type of garnishments or ordered usually, those the employer can take right out of your check. Flexible spending. I'm not going to have an example of this right now, but maybe in class I'll kind of give you an example of how beneficial flexible spending accounts are, also known as health savings accounts. They really do save you money if you use them properly. Let's look at an example now of how a journal entry will look from here on out when we talk about payroll. So I've given us a real brief little example. My example says, as of March 15th, my employee has earned $6,700. Now that's important because when we talk about caps, now I'm nowhere near the Social Security cap, and then no other items in the employee side has caps. But on the employer side, we do have two caps, and they are much, much lower. And we are in range of this guy here, of the $6,700. Now for this check, I'm saying we have earned $1,000. And then the rates that I have to give you, the SUTA rate, remember that depends on the employer, so that's going to be different per employer. I'm going to tell us that. This time it's going to be 4%. The federal rate, I'm going to give that to us every time as well, 5%. I want you to remember the Indiana rate. Remember that's 3.3%. And then I also have to give you the county percent, just depending on what county the employee lives in, because that's where it matters on the county. It doesn't matter where you work. You could work in Indianapolis, but if you live in Anderson, you're going to be taxed at the Anderson or Madison County rates. So as we go through now to do the journal entry, okay, the first thing that we do is the same as we've always done. We do a wage expense for how much was actually earned by the employee. So I told us we had earned $1,000. Now the next thing I want to do is simply go down each one of these taxes and take them out as a credit, because they're being taken out of that $1,000 that I'll never see, and that the employer kind of keeps in, like, think of it like a sales tax payable account. The employer withholds it from our check. It's not going to be their money. It's not going to be the employer's money. They're just holding it like sales tax until they have to pay it at some future date. So the first thing I'm going to want to do is Social Security. Now I'm nowhere near the Social Security cap. So when you add $1,000 to this, that would be $7,700, nowhere near the $127. So the entire $1,000 that I earn will be taxed at this 6.2% rate. So 1,000 times if you do it on your calculator, 0.062, that equals $62. Now I'm going to bring this down so it's all in one journal. And then we have the next tax, our Medicare payable. Remember, these are just like sales tax, so STP, this is the same thing. This is Social Security payable. Medicare, that's at 1.45%. So if you take 1.45% times what was earned, no cap, we get the $1,450. On the next one, I told us that the federal withholdings, another payable account, so we're racking up quite a few payables, was at 5%. So that comes out to be $50. The state for Indiana is 3.3, something I want you to memorize because that doesn't change. 3.3% is $33 coming out. And then the county is $20, 2% goes to the county. So right now we have 5 credits, but hopefully you'll see that we're not done yet. And the employer and the employee sure hopes we're not done yet. They've earned money, and then right off the top they've had all of this taken out. Almost $180 worth if you would add all those up. Comes out to be $179.50. That's quite a bit of money being taken out of taxes for taxes. That doesn't include any garnishments, any medical insurance premiums or 401k. And so the last entry is the kind of sum everything up and show how much did I actually write a check to my employee for. So out of the $1,000, my employee got a check for $820.50. And that would be now our debits equal our credits, and the employee is paid. The next thing that I like to look at before I go to the second journal entry is I like to get an idea of how much did I actually pay in taxes percentage-wise. So that's what I was looking at here. If you want to find out how much you actually pay in taxes, simply take the gross amount that you made minus all of these taxes that were withheld, and then divide it by your starting number, how much you actually made. In this example, this individual paid right at or almost near 18% of their wages went to taxes. So that's a decently high number. And as you see, some other examples will pay the higher income you make, the more tax percentage you pay in. But 17%, that's quite a bit. Now we're down to the second part of this journal entry. This took care of the $1,000 that the employee earned. But if we go back up here, that's not all that the employer had to pay. The employer also has to put into those tax funds these 4 taxes. So if we would put these monies away, the first thing that we're going to debit is our payroll tax expense. And before you actually do a payroll tax expense, you're not going to know what this number is. This number is going to be a big question mark, because the number that you get, which you'll see where I got the 118.30 in just a minute, where you get that is simply by adding up all the taxes that you have to pay. And all those taxes are as a credit, as a payable in your account. So we're going to have more money going into this Medicare payable account. We're going to have more money going into the Social Security payable. All right, so the first thing, remember from the employer standpoint, they match dollar for dollar how much was paid by the employee for the first two, the Social Security and the Medicare. So right now, the Social Security T account, if we were updating our T accounts, it would have $124. The Medicare would have $29 in its T account balance. Then the next tax, we go back up, the third tax on the employer's side is the FUTA tax. And I tell us that that's at 0.6% on the first $7,000 in wages. Well, this is where our individual's prior earnings come into play. If this individual has already made $6,700, I need to get to $7,000 and then stop. So what's going to happen, the easiest thing that I like to do is take, well, what's the cap, and then subtract how much I've made. So I've made, or the cap is 7,000, I've made 6,700. That means of the $1,000 that I've earned, all that's left to be taxed is 300. So when I'm doing the FUTA calculations, I'm going to take not 1,000 times 0.006. I'm going to take 300 times 0.006. And that leaves me with a very small dollar amount of only $1.80. Now, I could do the same thing for the SUTA. The SUTA is capped at $9,500. And I'm starting to get close. I'm not there yet. But if I would subtract the 9,500 cap minus where I'm at right now, that leaves me with $2,800 that still is taxable. I didn't make $2,800. So I don't want to tax $2,800 by any means. I only want to tax up to what I made. So right now, the Social Security cap isn't going to come into play. It will soon. But for right now, I still have a little bit ways to go. So the entire $1,000 is going to be taxed at the the SUTA rate. And I told us that the SUTA rate was 4%. 1,000 times 4%. Now, our final debit, if you would add up all of these taxes that the employer has to pay, you will then get $118.30. The second thing that we're going to look at, the second out of three things that we're going to look at this week, is interest on a note payable. Now, 2 weeks ago, the week before, 2 weeks before the test, we had interest on a note receivable, where maybe we did a job, like a roofing job, and then people are going to pay me over time with interest, maybe all in one lump sum perhaps. Or I took out a loan from a bank and then I'm going to repay it, say, in 9 months. And we calculated our year-end, like our adjusting entries, how much interest was earned, not necessarily received, but just earned. Well, we're going to take that a step further with looking at it from the opposite point of view. So we did it from the receiving point of view, whereas I am the one giving the note. Now I'm going to be the one receiving the note, where I have to pay back. Our company has to pay back money. And we can do it in one of two ways. We can do it like we have in the past, where we pay it off in one lump sum. And when we do that, we're going to need to make a year-end journal entry to show how much interest, revenue, or in our case, expense, had occurred. Now, the more common way is when you pay off your loan month by month, like you would for a car loan, student loan, mortgage, credit card. Most items you pay them off month by month. And when that happens, we're going to need to make, very similar to what we did with the depreciation when we made an amortization table, we're going to make another type of amortization table, and this time it's going to be on a loan. Because every time I pay down on my note, a little bit goes to interest, a little bit goes to the note, but that little bit that goes to the note actually decreases what I have to pay. If I had to pay $10,000, but $200 of that $10,000 went to the note, I only owe $9,800 now. So the next month, I'm only going to pay interest on $9,800 worth. And we're going to make a little amortization table to see how that works out with our example. All right, so here's my opening example. On July 1, we bought a car, $15,000, and we put down $3,000 up front as a down payment. The rest of it, I put on a 4-year loan that earns 9%, or that is earning 9% interest. And I need to start making monthly payments of $300. Okay, so what I first do is just make my typical journal entry. What did I get? I got a car, my vehicle. It's going to be in my long-term assets. How did I get it? Most of it was I'm going to pay back later, $12,000. The remainder I put down in cash. Now, when I start making my July 31 journal entry, I'm going to need to figure out how much of my $300 payment that I'm showing goes to interest, and then how much of that $300 payment goes to the reduction of my note. Well, we're going to do the same interest calculation that we've done in the past. I equals PRT. And in this case, our principal is real easy. It's just $12,000. So I equals the principal times the rate, which was 0.09, times our time. If we're only within the first month, that means our time is only 1 month out of 12. So if you do this calculation, you're going to get $90. And then I can start this little nice amortization table. So they're just different wordings than what we had on the depreciation. We're going to have cash payment on our first column here. How much am I making every month? How much of that cash payment goes to interest? And then whatever's left goes to the reduction of my note, which is a good thing. So if I had a $12,000 note payable T account, and then I debit that for $210 because I'm lowering the amount, my balance, if I was doing a monthly balance, would show only $11,790 left owed. And at this point now, I can go ahead and do the journal entry. And let's do that journal entry at this point. I'm going to, in a second here, I'll pull up the Excel sheet and you can see how it works out for the full 48 months because I said it was a 4-year loan. So we're on 731. Yeah, well, we'll leave it like that for now. And what did I get? Well, I got a reduction of my note for 210. I do want these all in one area. I got a reduction of my note. I also got a thank you for loaning me money. Remember, I couldn't have even got this car if I wasn't given a loan. And as a thank you, I have to pay them that 90 bucks in interest. And then how did I get a reduction of my note? And how did I get a thank you for loaning me money? I paid cash for the $300. So this is what's different from what we were doing previously. What we were doing in a couple weeks ago, we were paying the entire note off at one time. Now we're making monthly payments. So I can go on to the next month. What did I get the next month? I got another reduction of my note. But I didn't get a reduction of just 210 anymore. I got a reduction of actually 211.58 cents. It doesn't sound like a lot, but actually that does start to add up over time. And how I got that 211.58 is everything in my little formula stays the same, except the value of my note is now $11,790. So I redo my calculation for $11,790 and then work it out 9% for just 1 month from the beginning of August to the end of August. And that comes out to be $88 of interest and 43 cents, leaving the rest of it as a reduction of my note. So I can go ahead and do my journal entry. How much came off my note? Well, that was the $211.58. The interest expense was the $88.42. Thank you for loaning me money, all because I had a cash payment of $300. Now to show you what this looks like full-blown, and this is easy to do. You can do this with any of your student loans, your car loans, and I actually recommend it. I would hope you do, is I have the same type of headings up here. How much I'm making, how much payment I'm making, the interest per that month, how much comes off my note. Up here, I simply have a little calculation that shows my interest per month. So if I have a 9% annual rate, and then I'm only wanting it for 1 month, so 9%, if you divvy that down to 1 month, is 0.75%. And then I use this to fill in some formulas. So let's see how I did it here. We had a cash payment, $300. I just easily typed that in. Interest, I equals PRT. Well, here's the R and T summed up into one box now, the rate and the time. All I've got to do is get the principal amount. So this box times this box gives me my interest of 90 bucks, which I already figured, doing it the long way. Reduction of my note, well, remember the reduction of your note is what's left. I paid $300, I had 90 going to interest, so that leaves $210 going to the reduction of my note. So the new book value of my note, well, it was worth $12,000. I took off $210, leaving me with the $11,790. With these formulas put into place, I can then easily scroll down and not have to type in anything else. And you can watch the book value of my note as well as the interest continually goes down every month until I get down to the 48th month and my book value for the note is 0. Notice I had to make a change here for that final month as well. If I would have paid $300, it would have been too much. They would have owed me money. So whenever you have your final payment come due, you always tweak it to make it come out so your final balance is 0. So in that final month, only $1.64 went to interest. The rest went to the loan. So a total of $220.65 is all that I owed in that final 48th month. Okay, that will we're going to stop there for the first part of the lecture. The second part of the lecture, we're going to come back and look at time value of money.